Okay, so Crash Course is talking about the 2008 financial crisis. So, 6.2%. 6.2%. That was the default rate. It wasn't 10%, it wasn't 50%. 6.2% of people not being able to pay their loans destroyed the global economy. Now, in what world should 6.2% of people not being able to pay their loans completely take out anything? If you were thinking about this rationally, that's not half the people. Okay? So if 6.2 people can't pay their loans, then the bank rationally just takes it back and then resells it. And maybe that lowers home prices. But 6% of people, 6, not 60, 6%. That is not enough to actually cause a real crisis. But that allowed enough for derivatives to freak out. Now, once you understand how stupid all of this is, you will possibly be upset. The 2008 crisis happened because of the derivatives market. Prior to all of this, there was something called Glass-Steagall. Glass-Steagall said that the banks that give you home loans can't be part of the stock market that does crazy gambling, is realistically what it said. You can have loans and you can be a bank that does home loans, but you're stuck not playing all the crap that's in the stock market. However, everyone decided to repeal it, like during Bill Clinton's administration, I think it was. So, that is what caused this giant boom and bust. Other people keep lying to you about what actually happened during the financial crisis. Even to this day, 6% of people not paying their loans should not destroy everything. Just think about that. Think about how small of a number that really is. 6% of American homeowners couldn't pay back their loans. Thus, the entire global market was wiped out. Okay, so what happened was there were these loans. And then people have these magic things called derivatives, which they claim has all this fancy math. They do algorithms, I think, with them or whatnot to try to prove that these derivatives are awesome. But, you could create a derivative that claims a pile of horse manure is solid gold. And the market could claim that it was solid gold. But when you go back there, it's not going to turn into golden nuggets, okay? So, and that's realistically how this works. It's great that you try to put all these weird maths, but if what you're dealing with doesn't need any of this weird math, then it's kind of pointless to have all these equations attached to something that doesn't need it. Okay, so a $50,000 home might one day be worth $80,000. However, historically, it tracks with inflation, meaning if you took $50,000 and did the inflation of whatever era it is, then it's now worth $80,000 because of purely inflation. It pretty much is that. So homes were an investment. That means normal people can buy a home and it's always going to be worth what they put into it. It was just a great way of holding on to your wealth. Well, the market got a hold of homes. They've convinced everyone these are assets that increase. And you can make a huge sum on them. Which, okay, right now you can, but it's irrational. And what happened is there's these derivatives. And the derivatives market is like the futures of homes. And because they can claim like, oh, homes should be worth this in the future, well then you pay that price now for some future magical time period. Which is I mean, people who have argued this can kind of explain it with commodities that are going up and down a lot. Like having a derivatives market and having people bet on it allow like an airplane company to buy gasoline at a fixed rate so that it could actually stabilize its ticket price over a course of a year, and it constantly gets that gasoline for a specific price. Okay, that's fine if you're one of those guys. However, home loans are completely irrational on the derivatives market, and it should really be illegal. It's not, but it should be, and they're still doing it. So, no one knows how much homes were sold. Everyone, I'm pretty sure, agrees that it was at least 10 times the market value, at least. However, they cut them up and they mix them around enough that, $1 million home might have been selling for $100 million on the derivatives market. And there's no way to prove anything. But we are positive, $1 million home was being sold on the derivatives market for at least 10 million, 20 million, more likely more, but at least that. So at least 10 times its market value. So people attached retirement funds and had retirement funds buying derivatives and claiming they were good investments when they were selling a home that would have been worth $1 million for $10 million to these retirement funds is what was going on. So basically, that's called price gouging. If I took a bottle of water and lied to you and told you it was worth way, way more and sold you the same bottle of water that should be, worth $1 for $10, you'd feel ripped off. But that was perfectly okay. And so 6% was enough to stop the derivatives market. And because the derivatives market is foo-foo rubbish, everyone decided thinking, oh, maybe we should consider, the $1 million house a $1 million house. And once that happened, then all the money in the derivatives market evaporated. And then that caused people to freak out because banks were buying huge amounts of homes up. And so that house that was $1 million stopped being worth $1 million on that. It dropped down to $500,000 or $250,000. Okay, so it went back to a more rational price of a $250,000 house being worth a $250,000 house price instead of $1 million. However, that wiped out all the derivatives market that was selling it for $10 million. So a house now worth $250,000 is sold to retirement funds and is in retirement funds as a $10 million house. Yeah, wake up. That's what they did. That is just a scam. But here, crash course, explain how a scam isn't a scam for us.
And I'm Adrienne Hill. And today we're going to do something.
We get these lovely people who I'm convinced
we're going to explore one moment in history in depth. We're going to talk about how the 2008 financial crisis happened and the government response to it in the United States.
So let's get started.
I'm pretty sure they're not going to actually talk about derivatives, so they're going to lie.
The 2008 financial crisis was a big deal. Ben Bernanke said it could have resulted in a 1935
That guy's a freaking idiot, by the way. Ben Bernanke is a
But what happened? Why did it happen? And why we all huddled around burning trash cans, forming a raiding party to go steal gas from other tribes?
Yeah, why are we not completely destroyed by 6.2% default?
Seriously, put down your crossbows.
To explain what happened, first we have to do a quick explainer about mortgages.
6.2% default.
But basically, someone that wants to buy a house will often borrow hundreds of thousands of dollars from a bank. In return, the bank gets a piece of paper called a mortgage. Every month, the homeowner has to pay back a portion of the principal, plus interest, to whomever holds the piece of paper. If they stop,
look at how
that's
much
called
she
a
twitches.
default, and whomever holds that
Explain to me how she's not on cocaine.
The reason I'm saying whomever holds the paper rather
has
than
these
the bank,
look at
is
that
because the
movement.
bank,
That's
the
like
original lender, often sells that mortgage to some third party. And the reason I say often is because this happens all the time. I've had my house
She
for
loves
9 months,
cocaine.
and 3 different banks have had the
I
mortgage.
think.
Traditionally, it was pretty hard to get a mortgage if you had
know.
bad credit or
Is it
didn't
cocaine
have
or
a steady
20
job.
Red Bulls?
Lenders just didn't want
You
to
be
take
the
the
judge.
risk that you might default on your loan. But all that
6.2%
started to
default
change
rate.
in the 2000s. And before we go further, a quick aside here. The story gets complicated fast, and it's a fascinating
6
story.
out of
but we're trying
100.
to keep it
6
relatively
out of
simple.
100.
So I've asked Stan if we could put some additional resources in the YouTube description. And Stan said yes. Thanks, Stan. Anyway, back to our story. In the 2000s, investors in the US and abroad looking for a low-risk, high-return investment started throwing their money at the US housing market. The thinking was they could
They
get a
invested in
better
derivatives,
return
and
from the
derivatives
interest
drove up
rates
the market,
homeowners
but
paid on mortgages than they
okay.
could by investing in things like US Treasury bonds, which were paying very, very low interest. But big money global investors didn't want to just buy up my mortgage and Stan's mortgage. It's too much hassle to deal with us as individuals. I mean, we're pains. Instead, they bought investments called mortgage-backed securities. Mortgage-backed securities are created when large financial institutions securitize mortgages. Basically, they buy up thousands of individual mortgages, bundle them together, and sell shares of that pool to investors. Investors gobbled these mortgage-backed securities up. Again, they paid a higher rate of return than investors could get in other places, and they looked like really safe bets. For one, home prices were going up and up, so lenders thought, worst case scenario, the borrower defaults on the mortgage, we can just sell the house.
Okay, you repackage mortgages. Yeah. And then you repackage those same mortgages as derivatives. Okay? And then those keep being bought and sold, and that drives up those costs. And then all these are increasing. So then rationally, the regular market should increase because these are homes too. So you are actually, this is what caused it. It's a bunch of people buying it up on the futures market drove the increase in home prices. And then a handful of people went in on it too because prices were going up. But the biggest engine is this. This is what caused homes to go up. And it has nothing to do with 6%. If you have 100 people and 6% of them fail to pay their mortgages, that's what, 6 people out of 100.
House for more money. At the same time, credit ratings agencies were telling investors these mortgage-backed securities were safe investments. They gave a lot of these mortgage-backed securities AAA ratings. The best
They
of the
lied.
best. And
They
back when
lied.
mortgages were
They
only
lied.
for borrowers
They
with
knew
good
they were
credit,
crap.
mortgage debt was a good investment.
There is
Anyway,
literal
investors were
evidence
desperate to buy more and more and more of these
of their
securities.
emails
So lenders
talking
did
about the
that to
fact
help
that
create
they knew
more,
they were
but
garbage.
to create more of them, they needed more mortgages. So lenders loosened their standards and made loans to people with low income.
She
and
is
poor
not
credit.
telling you.
Securities
These
called
people knew it was
subprime
crap.
mortgages. Eventually, some institutions even started using what are called predatory lending practices to generate mortgages. They made loans without verifying income and offered absurd adjustable rate mortgages with payments.
They might have been fake people. Okay? There is some preliminary evidence of, them just creating fake people out of thin air that were supposedly buying mortgages to help drive them up. But okay, let's go back to just blaming poor black people for some reason, which is, I don't know, if you watch certain people like Steven Crowder, that's what they want to do. I'm not saying she's doing that. I'm just saying that's kind of like, I've heard that so much. I've heard so much. So, yeah.
People could afford it first, but quickly ballooned beyond their means. But these new subprime lending practices were brand new. That meant credit rating agencies could still point
Keep
to historical
speaking,
data
my
that
cocaine
indicated
princess.
mortgage debt was a safe bet. But it wasn't. These investments were becoming less and less safe all the time. But investors trusted the ratings and kept pouring in their money. Traders also started
banks
selling an even
were
riskier
lying.
product called
They got
collateralized
caught
debt
lying.
obligations, or CDOs. And again,
And the
some of
prices
these
kept going
investments were
up,
given
so
the
no one
highest
really
credit ratings
cared.
from the ratings agencies, even
Which
though
is the
many
stock
of them
market,
were
folks.
made up of these incredibly risky loans.
They
While
don't
the
care
investors and traders and bankers were
if they are
throwing
selling
money
a
into
pile
the
of
US
horse
housing market,
dung
the price of
for
homes in the
gold,
US was going up
as
and
long
up
as
and up.
everyone's
The
buying
new
it.
lax limit
They're only
requirements
upset
and low
if they're
interest rates
holding
drove
the
housing
deed
prices higher, which
when,
only made the
you know, the
mortgage-backed
musical
securities
chair
and CDOs
stops.
seem like an even better investment. If the borrowers defaulted, the bank would still have this super valuable house, right? No, wrong. Let's go to the thought bubble. Actually, let's go to the housing bubble. You remember bubbles, right? Rapid price increases driven by irrational decisions. Well, this was a bubble, and bubbles have an annoying tendency to burst, and this one did.
Okay. Once again, what happened were they created derivatives, which were future expectation of earnings. So they took homes and they packaged them up and they did future expectations of earnings over a time. And they gambled those things up. And once again, no one knows how much. However, at the height of the housing bubble, $1 million house might have been being sold for $10 million at least, if not $100 million on these markets. And these are what they shoved into people's retirement funds. And the banks knew all of this was crap. I'm just done with this video. It's that complicated. They sold retirement funds, $100 million homes worth $100 million on the market. And when homes stopped going up, then those derivatives never reached the $100 million mark. So they crashed and they burned and they took out the economy. Period. The end. That's what happened. Peace out. These coked up they're just not telling the. Okay, fine. Maybe they don't know the truth. I don't know. But this is rubbish. It was that complicated. Okay? They took $1 million house and they sold it for at least $10 million, if not $100 million, to retirement funds. And when the market stopped going up, that derivatives market completely crashed and burned. The end of story. And what caused them to stop going up was 6% of people not paying their loans. Stopped the insanity, okay? There was just crazy up and up trajectory. And 6 out of 100 people not paying their loans. 6% of everyone in the country not paying their loans. Rationally, what would happen is that might just stop it from going up. So, $1 million home stops going up and up and up. And then those 6% of people default. And then, home prices go down slightly. Except for if you sold that same home for $100 million to a retirement fund. They have me so frustrated I can't even talk. If you take a home that was selling for $1 million, $1 million, sold it to $100 million. Okay, I just give up. This is just too frustrating. I think I'm just repeating myself. I've said it a bunch of times, and I'm over this. So, I hope you guys have a fun time. I hope you guys grasp how simplistic it is. I will try one more time in the fewest possible words. If you took a $1 million home and repackaged it so that you sold it sometimes for 10 million, sometimes for 20 million, possibly, occasionally, somehow during all that repackaging, you ended up selling it for $100 million. No one really knows, and I don't think the information is even there to actually know how crazy it could have been. That $1 million home could have been sold weirdly for who knows how much. 500 million? That's not even crazy to say. I wish it was. We don't know. We definitely know they were selling $1 million homes for 10 times, 20 times at least, if not 100 times. Okay? We're not sure. However, what happened was people defaulting caused, the market to go down a little bit. And that then got people who, it wiped out the derivatives market, which took down the global economy. And when a global crash happens, then everything even goes lower and lower. So then the whole housing market after that crashed. What rationally would have happened if those banks weren't allowed to gamble is if the market went up and 6% defaulted, then homes would go down to like a previous state. $1 million home would maybe be worth, 900,000, and it would be stuck at that price for who knows, maybe a decade or something before they started like going back up. But instead, a cascading effect happened. But the reason why it crashed is they sold a home for 10 times to more. We don't know. 10 times, 20 times, at least, if not 100 times, its actual worth to retirement funds all over the place, to Greece's retirement fund, to the UK retirement fund, to teachers' retirement funds and firefighter funds in the United States. Okay, that's what wiped it out. And they're not going to tell you that in this video. So, you know what? You can go and you can look at how it happened and get a bullshit explanation that is literally, granted, this video should be, 1 minute long, okay? What happened was the stock market ripped off people by, taking a $1 million home and selling it for like $10, $20 million on the market to retirement funds. And when the housing market stopped going up, then people realized, oh, these homes will never get to that price. So, oh wait, the derivatives market crashes. The end. Okay, that's as long as the housing financial crisis should take. It's that complicated. I love all of you. You guys are brilliant, smart people, and I hope you enjoyed this. I am very, very frustrated because this is something that I've studied so much, and they keep lying over and over and over and over and over. I studied this so much, and it's just a joke. And it's that simple to explain. Bye.